Net operating income, NOI, is a key financial metric used in real estate to measure the profitability of a property. So, what is the profitability of a property? It is the total income generated from a property after deducting all operating expenses. Examples of income generated from a property, the biggest component is the rental income. But other than rental income, there could also be income from parking, and also, for example, for hotels, they also run restaurants and drinking outlets. For operating expenses, we have examples including like property taxes, insurance, maintenance, utilities, repairs, and management fees. But note that for NOI, we do not deduct any financing cost. So financing costs such as interest payments are not included because they would scale the property's operational performance. So the operational performance are the ones that we are only interested in. You can think of it like whether the property is fully paid or is on leverage. It doesn't matter in the calculation of the NOI. So in the context of real estate properties, NOI functions similarly to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. EBITDA is used for financial reporting in companies, and it's basically adding back interest, taxes, depreciation, amortization back into net income. While NOI is just the gross operating income minus the operating expenses. The main difference between NOI and EBITDA is that EBITDA does include non-operating income and also non-operating expenses. And also for NOI, depending on the property, sometimes depreciation and amortization is not included as operating expenses. But as we will see in the examples later, depreciation and amortization are included in the operating expenses. So this is also one key difference between EBITDA and NOI. Let's look at an example. Currently, 45 units are rented out. So not all units are rented out. Generally amount to 40% of the effective gross income. The effective gross income is after accounting for the vacancy. Like we said earlier, there are revenues in addition to rental income. So calculating the net operating income, we first calculate the rental income at full occupancy. So this is just a 50 units multiplied by $1,000 per unit and multiplied by 12 months because we're talking about $1,000 unit monthly. Other income, so this is from the parking and laundry, and we multiply it by 50, and this comes up to a potential gross income of $625,000. We need to account for the vacancy loss. Now for the vacancy loss, we will just deduct 10%, which is the vacancy percentage, and so 5 or 50, 10% of the potential gross income. So after deducting the vacancy, we will come out with the effective gross income. From the effective gross income, we will then deduct the property management and the other operating expenses, because these expenses are with respect to the effective gross income. This example, this comes up with a net operating income of $281,000. We will take a look at an example on CapitaLand Integrated Commercial Trust. This is a REITs, retail real estate investment trust. By looking at the financial statement for the financial year of 2023, we see that the gross revenue is about $1.6 billion. And taking into account the operating expenses of $444 million, we can compute the NOI to be about $1.1 billion. We can also see a breakdown of the gross revenue. We can see that the main component of the revenue comes from the rental income. It comprises of $1.46 million. And also car park income is about $41 million, and other income, which is about 60. So we look at the property operating expenses. As we have stated earlier, these include property tax, utilities, etc. Note that for CapitaLand, they do include depreciation and amortization as part of operating expenses. So this will come out about 434 million. So note that this is ties exactly the same as the one in the earlier slide. From the annual report, we can see the gross revenue broken down into individual properties. So for the financial year 2023, we can see, for example, for this Bugis Junction Mall, it will be $81.2 million. And we can see that it comprises of retail, office, and integrated development. So people from Singapore probably will find some of these names are familiar. Next, we look at another REIT. So this is a residential REIT by CapitaLand. So we have a gross revenue of 586 million and operating expenses of about 295 million, giving us an NOI of 291 million. Similar to the previous example, we can see a breakdown of the income. In this case, we can see that we have the rental income, which is about 561 million, followed by hospitality income. I would reckon the hospitality income be restaurant and drinking outlets, and also have car park income. So this adds up to 586 million, which is the same as what we have seen here. And also direct expenses. So direct expenses is just operating expenses, and these are operating expenses. Yes. So depreciation of PPE, property, plant, and equipment is also included as operating expenses. CapitaLand Ascott Trust consists of service apartments that spans across different countries. So I just took a screenshot in the annual report for Australia and Singapore. So the reason why I took those of Australia is also because Andre is currently residing in Sydney. You might be interested.